Don't make these mistakes in buying your next home. Don't let your kids buy a home before they know this. Don't miss these key, often hidden factors when buying real estate. We're going to cover how to focus on the right thing. A lot of people focus on payment and they don't consider enough about price, or they get into adjustable rate mortgages, and those could be problematic, or they're not sure the right down payment. If it's too small, they get private mortgage insurance. Too large, they tie up their cash. Not considering all the closing costs. This could be up to 5% of the price of the home. Plus, if you haven't put in a yard, they say 10% of the home price going towards the yard, so that could be a lot of money. Neglecting other high interest rate loans because you're so excited about getting a mortgage that you're not taking care of other things first. Far too often, people shorten their mortgages, forcing them into higher payments, creating something called equity jail with their money, and even having an amortized loan where you have so much upfront fees as far as the interest cost, and then moving later on or refinancing and rolling it to another property. And that happens quite often. It's actually part of the marketing for a lot of the institutions out there. There's also the additional cost of homeowners insurance, and maybe if you're in the wrong zones, there could be flood zones, there could be hurricane zones. It might be having to have a specialty policy or not getting insured at all. And then finally, just the process of buying a home can create lifestyle creep. I remember when my wife and I bought our first home. It was really nice, but the problem was we didn't have any furniture. So one of the rooms, we just put lawn chairs in there temporarily. With this place for a big TV, we had a tiny TV, and it was a lot to take care of. We had to they didn't even put in the mailbox. They didn't put in the garage door openers. There wasn't a yard. There were people coming all the time to sell us water softeners and a whole bunch of stuff. Let's begin with kind of the ream of this. I mean, have you ever tried to get a mortgage or a loan? Fake it till you make it doesn't work with a bank loan. They don't want to see your taxes, credit score. They want you to pay for an appraisal. They want to see your bank accounts. They want a hair and saliva sample, take a blood test, sign over your firstborn if you default. Okay, a little exaggerated on those last ones, but you're literally borrowing against every hour you're going to work for the rest of your life. It's insane. To get a loan, then the bank wants to embarrass you even more. Tell us about all the times you've screwed up. It's like they want you to get economically nude. So just how big is your wallet? It's creepy and uncomfortable. Seriously, would you rather get naked physically or fiscally right now in front of everyone? We definitely find out who's faking it then. Oh, I thought it would be bigger. That's not something you want to hear about your bank account either. It's not how big it is, it's what you do with it, right? Problem is, we think it needs to be bigger because of the people that are posting pics with a rented Ferrari or an Airbnb they pretend is their house. I call that the financial dick pic because you have to be a dick to post a picture like that. Plus, depending on the market, maybe your money doesn't look as impressive that day. It's not my fault. I was going to buy Bitcoin at 100. I got out of the market at the wrong time. I promised I had big money. It's just shrinkage. It's cold on Wall Street. Look, not many people have the cash to buy a home, so they often get a loan. And most real estate investors use leverage to acquire real estate. So here's what to watch for, what to avoid, and what to consider, how to make sure it's a wise choice for your family and your life. And maybe you have homes or you already figured this out. These are things to consider for your kids and hopefully eventually grandkids. So the first mistake is there's just so many additional costs. There's the closing costs. Let's talk about those. There's the appraisal and inspection, which, by the way, comes out of your pocket, not the bank's. Private mortgage insurance, if you don't have at least 20% down, that's an insurance that says if you default, it's helping the bank out. There's lender fees like a loan origination fee. Now there's what's called front-end points and back-end points. Front-end points might be like 0.5% or 1%, and that's of the overall purchase price that you're paying for the loan to the broker. But there's also back-end points, which could push your interest rate higher. It pays the lender, it pays the broker that's getting you the loan, but it might actually push your interest rate higher. So you have to watch for that because it's not as easy to see. There's credit report fees, and there's even underwriting fees, right? There's title fees like title insurance, title search, attorney's fees. There's escrow payments, property taxes, and homeowners insurance that's often prepaid into the escrow account. So there's even recording fees that goes to the local government for documenting the sale. Now, there's other costs that come up with a home. I mentioned them at the beginning. Putting in a mailbox, maybe garage door openers, water softeners, furniture. You know, that's all things can happen. What about blinds? Maybe they're not included. Or upgrades. Maybe you have a basic home and you want to add some upgrades, or now you might have to worry about pest control, or if you're like I'm in Utah, there's unfinished basements. Our first home didn't have a finished basement, and we paid to finish that. Later on, we had to pay to finish our yard. Now there's utilities. And the bigger the home, well, the more the utility cost can be. There's also repairs that when you're renting, you might not have these repairs. And I'm not talking people out of buying a home. I just want you to take these things into consideration so that you have the knowledge. Now, if you're part of a HOA, a homeowners association, there's fees for that. And here's another big one. The last home that we bought, the real estate had appreciated so much that we had an increase in property tax right away. So that's all considerations that are going to be added, some of those to your loan over time, some up front. That's a big part of the cost. Now, another mistake that people make when buying a home is they try to make a huge down payment to lower the payment. But a big down payment, these are amortized loans. So, yeah, you make a big down payment, but it doesn't necessarily shorten that loan. If you're getting a 15 or 30-year mortgage, that's how long it's going to be. Yes, it's a lower payment, but there's opportunity cost. There's lack of liquidity. What if this ties up a ton of your money and now you're one financial surprise away from actually getting into trouble or having to borrow from a credit card? It is important to avoid PMI by putting 20% down. You can either do that with your own money, or there's people that sometimes get a first mortgage for 80%, a second mortgage for 20%, which is usually a higher interest rate on that second mortgage. It's important to know what your cost of money is. Your cost of money is kind of what can you earn on your dollar that's sustainable, that you can count on for a long period of time. Depends on what kind of investor you are and what opportunities you have. Or it could just be what other loans you have. If you have really high interest rates on other like credit cards, that could be a problem, right? So if it's going to pay a 5% mortgage instead of a 20% credit card, there's a high cost of money. There's a big spread on that, right? So this amortized loan, as you make payments, or if you pay extra, it's still the same payment the next month. It's just shortening that loan, but you have now what's called equity jail. That's a loss of liquidity. So what happens for people sometimes is they have cash flow risk. That cash flow risk is they're doing all they can because they feel a burden of having a mortgage, and they've heard from other gurus, once that's paid off, life's going to be so great and everything's going to just work out for you. But then you have a change in career, or cash flow crunch in a business, or a surprise tax bill, or a health issue. So don't tie up all your money. I once watched Susie Orman, and she was saying to someone who said, I have a very volatile income. I'm in real estate sales, and sometimes, I have a good month. I make 30 grand, and the next month I don't make any. And another month it might be really minimal because I only sell one home. And I'm really worried I want to pay off my mortgage. And she gave some of the worst advice I'd ever heard. She says, well, take that 30-year mortgage and make it a 10-year mortgage. 30-year mortgage gave flexibility. He could have saved up the money, and when there was enough, pay it all off in one lump sum, but have that safeguard in case something happened. So be careful, because it could be risky the way people go about paying off these mortgages that leads to potential default. We watched this in 2008. You might have two people that neighbor each other. They both have similar careers, similar income, similar homes. One decides to do a 30-year mortgage and pays the minimum. The other one gets a 15-year mortgage and pays extra. Now, if they both lose their careers, which happened in 2008, the person with the most equity was at the most risk because the bank had incentive to foreclose on them first, because there was potential profit there. There was less loss, at least, because there wasn't a lot of profit that was happening in 2008 and 2009. So you have to kind of consider, if it's fully leveraged, well, the nice thing is there's no equity at stake or at risk if you're outside of like Florida or Texas that has Homestead Act, which protects your equity. Other states don't have that protection. So if there's a lawsuit, that equity becomes something that's available in that lawsuit. So just some things to consider. Now, another mistake people make is they buy on the payment without really thinking about the price of the home. When interest rates are low, we'll see a lot of times prices go up. We watched this in 2001 and 2002. The price of real estate went up substantially because interest rates got so low that you can get a sub 3% mortgage fixed for 30 years. And so the payment was lower than when interest rates are at 6 or 7%. So that starts to impact the price of the home. So sometimes people overextend. They get bigger homes because the payments are so low. And now there's more utilities and there's more to take care of and there's more things that can kind of go wrong. And so I think you got to look at the purchase price and what's in the right category for you and the payment. Take both things into consideration because other factors are going to impact your price. Your property tax. I've even seen where people will go buy a home really far away because it's a lower price, but now there's all the driving that they have to do. And what's that time worth where they're in the car and the wear and tear on the car and the cost of, gas for doing that? Or, I guess it might be an electric vehicle, but still, what's the opportunity cost for the person? And some of those developments are just cheaper because they're less desirable land. And, sometimes you've heard this statement before, location, location, location. And so if it's further from work, further from friends, further from amenities, it's just could be quite an inconvenience. The next piece is determining, and where people make a lot of mistakes, is determining what's affordable. Now, I'll go through a couple ideas here. But if you have less than 6 months of savings and liquidity, or you use your 6 months of savings and liquidity to make that down payment, you now put yourself in cash pressure. You have to earn to make those payments. If you're a real estate investor, it might mean, what if you have tenants that, steal your copper wire and they leave and they didn't pay their rent, or they squat for months, depending on the state you're in, and all of a sudden you have this cash flow crunch. So don't sacrifice or eliminate savings and liquidity just because you're so excited to get a home. First, look at the liquidity. Second, are you able to create the habits that help you to build that safety and liquidity? Are you able to save 15% of your income and automate that savings? Or if when you get a higher mortgage, or now have more utilities, or now you're responsible for all these things to take care of. I mean, right now this morning, we have on our heater, I could just hear it. It's super loud. So we got to have someone come and take a look at that. The motor that's heating our pool, I mean, it's super loud right now. So these are things that have to be taken care of. And the more things you have, the more there is to take care of. So make sure you can start saving money, have that liquidity, pay yourself first, and then still afford the home. And there's just lifestyle expenses that are out there. Lifestyle expenses are like utilities, clothes, food, all those kind of things. My recommendation is try to pay cash for all those things possible, but cars and homes, that might not always be the case. I do pay cash for cars, but I have a mortgage on my home, but I have the cash to pay off the home if we really chose to do that. It's just that I'm earning 5% in cash value, and my home mortgage is only 2.75%. So I'm far outpacing what I'm paying. And some of the financial gurus would say, oh, but you just got to have those paid off. Well, it would slow me down, and I wouldn't have access to that cash. And, there's potentially a little bit of tax value or tax deduction, but that's not the main reason I would hold on to it. There's a few formulas out there on how much you can afford. One's called the 28-36 rule. It's pretty widely accepted, used by lenders to determine affordability. It's 28% of your gross monthly income. That's your housing expenses, like your mortgage, taxes, insurance, your HOA fees. And they don't want to exceed 28% of your gross monthly income. 36, the second number on that, is your gross monthly income. It's your total debt payments, including housing, car loans, student loans, credit card debt, all those other factors. And it's to not exceed 36% of your gross monthly income. But when you think about it, how much interest is going out if 36% of our income is going to pay for loans? Now, some of that's going to be principal, but others not. So just something to consider. I think that's kind of on the higher end. I mean, what this is basically saying is if you had like a gross monthly income of $6,000, 28% for housing is $1,680 a month. 36% for total debts is $2,160 a month. I mean, it's going to be hard to probably find a home in the price range that we're talking about here for most people, depending on where you live, especially if you're in a big city. So you have to look at how much money you're actually earning, and this is why I would really urge you to focus on creating cash flow from assets so you're not burdening your income to pay for a home that's not actually a cash flowing asset. Now, you might choose to rent out the basement if you have a basement, and that might help, assist in this. And I do think it's nice. Like, there's a quality of life of having a home. My wife and I are in our third home since we've been married for 22 years, and we love our home. It feels like a spa when we're there. We have a gorgeous view. It's something that we worked up to. But I made sure, I've always had it that I've never bought a home that was more than 1 times my annual income. Now, I'm an entrepreneur, and I've invested heavily in growing my businesses and be able to have that kind of income. And then I sold my business. I didn't have that kind of income that would qualify for how much I paid for our newest home. But that is a pretty strict rule. I'm not saying everybody should adopt that, but it just left me in a place of peace of mind knowing that the mortgage would never kind of be a problem to pay. Now, let's just look at another example here, the 25% rule, simpler rule. It's a conservative approach that recommends your monthly mortgage payments alone, principal, interest, taxes, and insurance, or private mortgage insurance, should not exceed 25% of your take-home pay. This is net income, right? So after taxes and other things that come out of your income. So if your take-home pay is $4,000, and it's saying you can have $1,000 a month for your housing costs. So again, you have to think about other loans not being paid off. What if you have, this is the next piece. is what if getting a mortgage prevents you from paying off high interest rate credit cards? Those high interest rate credit cards could be costing you so much money and be detrimental to building wealth. That's one of the issues of getting too excited or moving too quickly or feeling like this is something that's part of the American dream. Well, it's kind of a dream for some people because they get overextended and then they feel all this stress of paying all the bills and keeping everything up. So you have to really look and say, what is it that you can afford and what makes sense based upon your situation? The next issue or mistake is adjustable rate mortgages. Look, there was a time where interest rates just stayed low for a very, very long period of time. We had like well over a decade or more where interest rates stayed pretty low. And then all of a sudden, 2022, towards the end of that, 2023, interest rates skyrocketed. They went from 2.75% to like 6%. That's a pretty major adjustment. If you have an adjustable rate mortgage, there used to be these things that were called option mortgages, where you have an option to pay one of four types of payments. You could pay a 15-year mortgage, a 30-year mortgage, an interest only, or a negative amortization mortgage, where it meant you didn't even cover the interest and they moved it back to the end of the mortgage so that you owed more. And people loved using these until 2008 happened, and it really collapsed the market with those types of loans. So if an adjustable rate mortgage, you might have heard of something called velocity banking or a HELOC buy-down, home equity line of credit, where people will get these like lines of credit. They'll take all their income, pay down their line of credit, put everything on a credit card and float the bank's money for 30 days and then pay off the credit card with a line of credit. And what it does is it starts to lower the payment over and over. But if interest rates start to increase, that could be a problem. Here's another issue. Shortening your mortgage. Shortening your mortgage means you're fixed and locked into a higher cash flow payment. Now, what happens if something changes in your life and all that money's tied up in your mortgage? Banks love to lend money to people who don't need it. If you need it, they're like, no, thanks. The more equity you have and you don't have a job, it doesn't really matter. They're not looking at the equity in the home. They're looking at your ability as a borrower to be able to pay them back. And there's some people that use lines of credit. They pay it down and they use the line of credit and they think, okay, I'll use that line of credit as my kind of savings account. But in 2008, they got rid of those. They just cut them out. So people thought they had access to money they didn't actually have access to. The eighth issue is amortization. Your balance lowers, but your payment stays the same. So if you pay extra, lowers the amount that is owed, but it doesn't shorten it does shorten the amount of time, but it doesn't lower the payment because it's a fixed payment with amortization. And it also front-end loaded on your interest rate. So if you look at an amortized loan, you're going to see so much interest in those first years that you're paying. The ninth issue here is when people get close to paying off a loan, they'll start getting advertisements from the bank and say, did you know you keep your payment the same and buy a new home? Just roll that equity over and then start over again. Maybe you only have 3 years left. And they're like, oh, you go to a 30-year mortgage. Yeah, you have 27 more years now by rolling it over. Yeah, it's the same payment because even in an amortized loan, if you only have 2 payments left, it's still the same as the first payment that you made if it's a fixed interest loan. So now you're resetting the time period for paying off the home, and there might be a lot more expense by moving into a new home, especially if it's like unfinished parts of the basement or the garage door opener. There's just a lot of stuff that often isn't included. Now, the final piece is the tax tail wagging the dog. There's tax changes. So some people are like, oh, I want to have a mortgage because that gives me a tax benefit. But there were phase outs after $750,000 if you're married or $375,000 if you're single. So, okay, let's look at the tax advantage this way. Maybe if you're in a 20% tax bracket, if you're paying 5%, that's more like paying, 4%. Okay, but I wouldn't do it just for the tax advantage. You have to look at that secondarily, not primarily. The 11th issue is just opportunity cost. What amount of time does it take to make up a home, move into a home, take care of everything with the home that if you're a renter, hopefully someone else is taking care of that for you. Now, I've owned homes. I've rented. I prefer owning. I'm just giving you the insights I wish I would have known when I bought my first home. There's a lot more cost than I ever expected. There's a lot of things that we added. We added things like, I don't know what it's called, but it took forever for our hot water to warm up. So we put like this recycling thing in there so it would automatically be hot. That was an extra expense. There's just little things that added up over time that I didn't expect. The 12th issue here, or something to consider, is if you're not creating cash flow and now you're increasing your expenses, it's going to take you longer to become economically independent. Economic independence is where you have enough cash flow from assets to cover your expenses. For a home, it's a lot of people consider it an asset, but it's more of an expense. Yes, it can appreciate in value unless you're going to Airbnb it. The reality is it's an expense. It's not like you're increasing your cash flow or helping you get to economic independence. So is there a way to live a life that you love and enjoy your life until you get to the place where you have enough cash flow that this makes sense, so it's not just coming out of your earnings? And the last piece to consider here is insurance. Some areas require specialty insurance. I just was meeting with someone at this very table doing a cash cabin immersion. As we were talking, they have to pay $28,000, I think, a year because of the area where they're at. There's a high fire risk. And so they just have to pay a bunch by a specialty insurance company. I know other people that live on the coast of Florida that can't get insurance right now because of floods. This cabin right here, our cost of insurance for flood massively increased, and they lowered the amount that they would cover. So it went up like 4 times in the last year, but they cut the coverage in half. So this is happening more and more. So you have to take those things into consideration. And finally, 14th piece I've kind of mentioned, but instead of considering your home as an asset, look at it as a quality of life factor. It's not creating cash flow. And don't look at rent as throwing your money away. I remember people saying, I'm just throwing my money away. Well, if it's a lower amount and you don't have to maintain all this and have all these additional expenses, and you can put that away to create cash flow, you could be in a much better situation, increasing your liquidity, getting financially stable. Those are all key factors. So let me recap. If you're focused only on the payment and not considering price, there's so many other factors that can eat you alive. If you're in an adjustable rate mortgage, that can increase over time and become a problem for you and put your home at risk. If you put too much of a down payment and you limit your liquidity, you don't have cash for when other opportunities arise or when there's financial surprises. If you don't put enough, there's private mortgage insurance. Not considering closing costs, which could be 5% of the price, can become very harmful to your overall wealth plan. And then 5, neglecting other high interest rate loans because you have credit cards you haven't paid off, but you're so excited to get into a home that you're delaying paying those. Or you shorten your mortgage because you think the only way to pay off a mortgage. And I could share a story with this. I was in class in Mr. Moinier's teaching, Coach Moinier, and we're learning about just interest, right? We're just learning about 15-year mortgage. You pay a lot less interest than a 30-year mortgage. And I ran home to my mom. I'm like, Mom, are we on a 15-year mortgage? She's like, of course we are. We're not going to pay all that interest. I'm like, thank God. Then I went to Professor Hamlin's course on economics in college. I learned about opportunity cost. And it's that we always pay interest, whether we pay cash and forfeit the right to earn it or whether we borrow. It's easy to see what we borrow and pay. It's hard to see what we forfeit and give up when we pay cash. And so if I could earn 5% or had to pay 5%, it's the same interest cost. It's just which one makes me feel better. Maybe paying off a mortgage makes you feel better. That's great and objective. But for others, it might be, well, I want to have that money in case a good opportunity comes along or a financial surprise. So shortening your mortgage, if you could earn 5 or pay 5, it doesn't matter whether you cash 15 or 30 year, it's all the same interest cost. Then looking at an amortized loan, you will have more upfront costs. So if you're moving all the time or refinancing all the time, like when interest rates were changing all the time, when I first got in the financial business, people are refinancing every 3 to 5 years. That's a new cost to the loan. There's, now you're right back to the beginning and you just added the 4 or 5 years. So something to consider. Don't just roll equity from a previous property and not consider the time that you've just increased. And then look at the homeowner's insurance that you might be paying, what that means and what that cost is going to be if you're in certain areas where that could be a problem. And then just lifestyle creep. You start having to buy more furniture. You have to start adding a lot more things. We're putting in a backyard at our house this next year. It's expensive. It's not cheap. So, I've been so focused on making sure, because I've been financially independent multiple times in my life. And then after selling a business, we've increased our lifestyle enough that I'm still having to increase my cash flow again to be financially independent once again. So I'm careful, and I've been delaying putting in this backyard, even though it's something that we want, to make sure that we're financially independent fully with enough cash flow, monthly recurring revenue, and cash flow from assets to cover that. So here's the rant. Don't let people hijack you and make you feel guilty. Oh, you've got to get in a home. Prices are going up so much. Now's the best time. Real estate always goes up. They're not making it, you hear all this kind of stuff. It's not really throwing away money. It's about what works for you. not about proving what you are to someone else because of the size of your home or the things that you have in it or having all the best things without having the right financial situation for it. Because if you finance your life, you create stress, you create risk, and unfortunately, you delay economic independence, which can diminish your dreams. It could harm your vision. It can create a whole bunch of scarcity. It create marital stress, all these things that can have such a huge impact, yet people are sold this dream. You got to have the white picket fence. And I don't know if that's still a thing, but I remember growing up, they said that. So you got to ask, what's your preference? What really matters to you? What would it look to have financial stability, financial security? What works as a starting step? It doesn't have to be the ideal thing right from the beginning. Don't allow guilt and shame to dictate anything around this topic or fear-mongering. Oh, you better make an offer today. There's a bunch of people that came and saw this. And I mean, there's so much that happens in this world of real estate. And when we don't take into consideration all these factors I discussed today, we put ourselves at risk. So the question is, what would money Jesus do? What would money Jesus do? Well, build at least 6 months liquidity, right? Use a fixed rate loan instead of an adjustable rate loan. Avoid PMI by making enough down payment. You don't have to pay that. And make sure it's a place that if you have opportunity with the basement that you might be able to rent out to create cash flow. You could even rent the whole house out for 14 days a year. Maybe there's a certain big event that happens in your town or your city. You could rent it out for more during that time because of the demand. Like I had an apartment that we used to rent out when there was the outdoor recreation show. And that was the only time we rented out during the year, but we got so much that came in that it paid for months and months of that apartment. And it was tax-free because of the Augusta rule, which is 280G. So you could actually rent it out to help with the cash flow. Be strategic about furnishing. Be strategic about home improvements. Set up a goal on creating cash flow and having wins in your business or in your life, or creating, an asset that's creating cash flow, and then take a part of that and do this over time. It doesn't have to be done overnight. Focus on creating economic independence and then watch everything else start to happen in a much bigger way. See, if your objective is to pay off your home, that's a great objective, but be careful about the method. See, peace of mind and economics should both be considered. Economics is, does it make sense to pay this off because it saves us more interest than we could earn? Or do I have a low interest rate loan from a few years ago and I can way out earn with even U.S. Treasuries or cash value life insurance that I want to pay there? And it could actually help me pay it off faster by earning that interest. Save up enough money if it's really your goal to pay it off and pay it off in one fell swoop. See, it depends on the interest rate and the opportunity. Maybe you'll never pay it off like I have my home. I don't ever think we'll pay it off. We think it might be at our lifetime home. We may never move from that home. I don't know. That's how we feel about it. We love it, but we don't want to trap our money in equity jail. We want to keep liquid to handle opportunities that come along, to earn more interest than what we're paying. You might want to keep your money to handle surprises or whatever might be in store for you. The reality is this is a big choice and a big decision. Hopefully I've given you some ingredients and insights to make much more informed decisions so you can take back control of your finances and build the life that you love.